for regular tax purposes is long-term capital gain. However, especially for incentive stock options, I think we'll probably talk about it in a little more detail later, we have an AMT problem, alternative minimum tax. We got to move on. So,
well, you
again,
did that very well.
okay, so let's talk for a moment about non-qualified stock options. What are some of the things special about that? So I think the first thing that you said is that's the only one we can get for a non-employee.
Right. They have vesting periods. They're non-transferable. They're non-pledgeable. You can hedge them, although sometimes companies prohibit you from hedging them in the plan documents.
Yes.
Okay. Now that's in the minority, and sometimes there's some discussion about whether this plan really prohibits it or not.
Yes.
But the great majority of the options that are granted are non-qualified options.
Yes.
And it has different tax consequences to the company too. When you exercise that, they get a deduction for the full amount of the intrinsic value.
Yes.
The intrinsic value, we might as well say what that is now, is the difference between what the exercise price is and what the stock is trading for when you exercise.
Right, the excess of the fair market value over the option price. So there's a couple of other things I'll just throw in. One is that for non-qualified stock options, income taxes are withheld at exercise.
That's right.
And so that doesn't apply for incentive stock options.
That's right.
Employment taxes also, like Social Security taxes and Medicare, apply when the option is exercised. And if you're talking about a self-employed person, again, a non-qualified option can go to a self-employed person like a consultant.
Right. That's right.
That person will have to pay self-employment tax related to that gain. Okay, so let's move on.
Okay.
What are some characteristics of incentive stock options?
Well, the characteristics is we kind of went through it, Michael.
Yeah.
And that is you can get long-term capital gains treatment on the profit.
Right.
And that's the biggest thing, that if you comply with the requirements of the 1-year holding period after you exercise and a 2-year period from the date of the grant, for all practical purposes, you can get long-term capital gains. And it makes a big difference between long-term capital gain and ordinary compensation income.
Yes. So
the AMT implies,
Yeah.
but that gets a little complicated, and it might take the whole session to explain that away, and
Okay.
you're more of an expert at that than I am anyway.
Okay, well, I'll talk about a couple of things in addition here. So one thing is, for regular tax purposes, when you exercise an incentive stock option, there is no taxable income at that point. There is for AMT. Now, technically for AMT, what happens is that it's treated the same as a non-qualified stock option, because the rules for incentive stock options just don't apply for AMT. But what it means is you're picking up this income amount on a different income schedule. The tax rate for AMT is 28%, is the maximum rate. That's what I'm dealing with most of the time with my clients. The rate for long-term capital gains is 15%. This creates a problem because there's this thing called the AMT credit, where you get to recoup and treat some of that AMT as a prepayment of tax. But you can only use it for the long-term capital gain piece, basically, and at the 15%. So you don't get to recoup all of it. Effectively, you're stuck at that 28% rate that you have to pay related to that part of the gain. If the holding period requirements aren't met when the stock is sold, again, it's ordinary income, that income can be limited when you sell the stock in the same year that you exercise. It's sort of an important exception. I call it the escape hatch. So what it means is, if you exercise early in the year, you've got this big gain, and then the stock goes down before the end of the year. If you sell the stock before the end of the year, you can have your gain limited to the excess of the sales price over the option price. That only applies for the year of exercise, and there's other rules that apply there. So yeah, John's smiling because we're getting all this technical stuff.
That's what your accountant, you go see your accountant for that.
Okay.
I'm more or less saying how to handle them.
Okay.
And,
yeah, well, we'll get into more here in a moment. There is another thing. One reason why non-qualified options are more widely used is that you're limited on the amount of incentive stock options that can be granted. Only up to 100,000 can be exercisable in a year. Okay, now just briefly, John asked me to bow out on this one, so we're going to talk a little bit about employee stock purchase plans. As we said, the holding period requirements are similar, but the AMT does not apply. For an ESPP exercise, there is a discount. It's usually 15%. It's based on the fair market value on the grant date or the exercise date. You can usually use the lower of the two prices. And the floor on ordinary income doesn't apply. So in other words, if you sell an ESPP in the same year that you exercise, you can end up with this ordinary income for disqualified disposition and have a capital loss. It's not a good combination, so you need to be careful about that and get advice related to that. Okay, folks. So we've sort of zoomed through here to cover some of the basic information. But now we want to talk a little bit more about value and some of the things that John in particular is concerned about people maximizing value from these options as an employee. So John, please explain how you see the value of employee stock options when they are granted.
All right. Would you please put that first slide up?
Okay.
Here it comes. Okay. But we can start it
okay,
before
go
it comes. The options, when they're granted, have a value.
Yes.
Even though you're restricted from selling it because you can't sell them at all and you can't even exercise them. Okay? But when they're granted, they have a value. Now, FASB, that is the Financial Accounting Standards Board, and the SEC require companies, when they grant these options, to put a value on those options for cost purposes, which they'll expense against their earnings as the options vest. Now, you know, there's a lot of discussion about what those options are worth and should be cost. And then on the other hand, there's some discussion about how much does the employee or the grantee perceive those options to be worth. And it's not always the same, I'm sure, because if part of the formula for
Go ahead, John.
calculating the theoretical values, which they use.
You can look at me, John.
Huh?
Look at me while you...
Okay. Part of the calculation is the time remaining, the volatility, the dividend, the interest rate, and the expected time remaining. Okay, most of these options, as we discussed earlier, have 10 years maximum life.
Yes.
But the calculations assume perhaps a 6%, a six-year life, and there's some discretion about the volatility because that's a big factor in calculating theoretical values of options. There's a lot of discussion about whether they use 1 year's historical volatility or what they call the implied volatility by looking at the listed exchange-traded options to get an indication of what the volatility will be in the future. So there's a lot of assumptions you make when you going through this calculation. Now, would you put up the second graph, please? Okay, so this here shows the Black-Scholes calculation, which is the using the Black-Scholes theoretical pricing model. We have calculated the value of the options. We're assuming in that block that the exercise price is 20. The stock price is 20 at the grant date because we're assuming that the options are granted with an exercise price equal to what they're trading for. Mm-hmm. In this case, we're assuming a volatility of 30, and I'm not going to explain what volatility is because it's pretty esoteric. We're assuming here a 5% interest rate, and that's the risk-free interest rate. That interest rate is lower now, of course, but when I made this graph, it was 5%.
Okay.
And the expected time, even though the maximum life of the option and the contractual life is 10 years, for our calculation purposes, we're using 6.5